Hello and welcome to episode 231 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, how you doing?
I'm good, Andy. Very good. I'm just about to head off after I've recorded this podcast to my daughter's sports day. So a bit of a, as Andy would say, look behind the curtain, what goes on at Money to the Masses. So I'm going to be doing this podcast on a Friday and then hot-footing it to a sports day if it stops raining. So I'm excited. I love a good sports day.
I love a sports day. I've had a sports day this week as well, and it's the first year that I've had both my daughters do a sports day because I've got a 5 and a 9-year-old who are at the same school, and it was really interesting to see the sort of differences in personalities between the two because the older one now, she's used to it. She understands what's going on. She's so competitive. The younger one couldn't give. She was looking around, she was just having a lovely, lovely time in the sunshine. So yeah, it'll be interesting to see how it develops over coming years.
See, my daughter, she is my eldest. She is really competitive, and I'm not just saying this because I'm a dad, but she's really good at like running and sprinting, and it's her competitive nature comes through, which obviously partly comes from me, but also my wife, because we're both competitive. But any long-term listeners will probably be thinking, Damien, are you going to do the dad's race? And anybody who's listened to this podcast since its beginning will know that I now no longer do dad's races after I tore my hamstring in one about 5 years ago. So, no, I won't be doing any dad's race. But, yep, after the podcast, that's what I'll be doing.
Do you know what I found was quite refreshing this year, just on the sports day thing? They did girls' races, boys' races, and then they did, I don't like the fact that they called it gender neutral. They should have just called it mixed or whatever. But they just let the kids run against each other, and there was no sort of segregation, no arguments. Maybe they should just do that from the get-go and not actually separate them girls and boys from the start. I don't know. What do you think?
And also, I do like the fact there's an element of competition. I think that's the key to any of it, because I know Justin's school, so his daughter doesn't have a competitive element to their sports day, which mainly people may disagree with me, but I think what's the point? I don't know. What is the point, Andy? Unfortunately, the world is a competitive place, so you're teaching your kids that anyone can win, and it just isn't true. But anyway, onto the podcast. Talking about teachers, before I go on to the what's on the podcast, I want to talk about a piece that was on last week on the podcast, which focused on teachers teaching us about how best to talk to kids about money. And there was a slight follow-up I want to add to that, just a quick anecdote from my sister, in fact, who is a teacher. She teaches young children. And I was chatting to her about it over the weekend and said, I'm talking about some of the stuff you mentioned to me and other people about teaching kids about money. And one of the things that she mentioned that I thought I'd pass on was the fact that children don't always appreciate what a job is. And so they don't necessarily understand where money comes from. So one of the things they think, or her children typically do in her classes, is that money is in a bank. You just go to a bank and you get money. You ask for money pretty much. So there is no sense of earning money. And they didn't understand, and her job is being a teacher. I think they think she's an extension of parental responsibility that occurs in the world, that their parents look after them during the night time and in the evening. And then she, my sister, teaches them during the day and looks after them. So they don't realise that is her job. She is paid to do that. So there's a fundamental thing in the world that we all have to do something for money, whether we like it or not, and children don't always grasp that. And I think it's easy to forget. There are simple things like that kids don't understand. So it's worth talking to your children about your job, which is always complicated when I talk to my children about what I do, because it's a new thing, isn't it? This job didn't exist when I was at university. So trying to explain to my 9-year-old what I do is very difficult because I'm not always sure what it is I'm doing. Oh, don't forget, as we said last week, we're going to pin a post on our Facebook page where Andy and I will be writing in the comments on Monday lunchtime. We're going to do it between 12 and 2 p.m, so when you're having your lunch, hopefully, and you can go on that post. It's the post that's relevant to this podcast, and we're going to be in there. You can talk to us, talk about the show, ask us questions, talk about anything. You can ask me what I think about the new Spurs kit. I don't care. You can talk about anything. It's about building a sense of community. You guys do like meeting each other and talking to each other when we do the meetup, so we want to try and build that online with a focus around a particular episode, but you don't have to just talk about that particular episode. You can talk about anything. So hopefully we will see you there on Facebook. Anyway, on with the podcast.
Yeah, what have we got coming up on this week's show?
Right, an investment piece I want to focus on this week is to do with investing relationships. And by that, I mean where you have certain correlations between different assets maybe, or indices. And the reason I want to focus on it is when I pick up the phone in the morning on a stock app that I look at just to see what markets are doing, then I base a lot of what I'm reading or interpreting on some of those fundamentals that are in the back of my mind. Now, in a previous podcast, I sat down and told you about what is on my stock app, which indices I check first and look for. And now I want to just add to that really and talk about the things that are at the back of my mind, the fundamentals, the sort of truths that seem to hold most of the time that help me interpret what's going on in the world. The next piece is going to be about loans. So the next part of the whole podcast really is about borrowing money. So one of them is about something called child benefit loans I want to touch upon. And then the third piece is about remortgaging versus taking out a loan, particularly if you want to do home improvements. Now, everybody at some point, if you're a homeowner, will get to the stage where they decide that they want to do the kitchen up or do the bathroom up, and they want to know how to fund it. Now, I'm going to do a piece on that, and actually it's very relevant to me.
Good. So what are we going to start with?
We're going to start with the investment relationships piece. Now, there are a lot of truths in investing, and a lot of them actually don't work all of the time. But there are certain things that I keep at the back of my mind when I look at indices, when I'm reading content to try and understand it. And there is a danger that we try to explain everything that happens in the investment world, and you have to understand and bear in mind that we can't understand everything. So there's a fixation. If you go and look at the media and the national press, they will always explain every tick up and down in the stock market, and it's down to something like it.
Trying to explain the whys rather than just sort of...
Yeah, they're trying to just give some insight, and sometimes there just isn't. It's like trying to explain
the weather.
I was going to use a similar analogy, the waves in the sea. Why the weather? Why is the weather doing what it is?
Why is it raining today, sunny tomorrow?
Yeah, it just is. And so you can try and predict things based upon the information you have, but trying to say the why, it's just sometimes life, you just can't explain it. And we have to be careful of that. But having said that, there are general truths that tend to hold that can help you try and understand what is going on in the world of investing. So I want to give a rundown of some of those that I look at. Now, the first one is a well-known one, the FTSE 100 and the pound. So whenever the pound falls, the FTSE 100 tends to rally, tends to get pushed up. Now, that's because the large cap stocks in the FTSE 100 index, which is the index of the biggest UK companies by market cap, they tend to earn most of their earnings overseas, and it tends to be a lot in dollar terms. So when the pound falls in value, particularly against the dollar, then it means those earnings from overseas are worth more when you convert them back into pounds, which therefore means they're more attractive and pushes up their share price. So that is why when the pound falls, the FTSE tends to rally, and when the pound rises, the FTSE 100 tends to fall. Now, it's not a direct relationship. It's not one in one. So when one goes up, it doesn't go in lockstep, or when it falls, it doesn't tumble. But have a look today. Just keep watching it on the stock app that you get, and just see how uncanny it is that you can have the rest of the FTSE all share, so the rest of the FTSE 250, for example, going up, and then suddenly you look at the FTSE 100 and it's down. And the reason can be, you go, oh, is it to do with the pound? Has the pound rallied today? And then you look at it and go, there we go. And then you might wonder, why has the pound rallied? So that starts to give you starting points to what you want to explore. Now, one thing to bear in mind when I'm doing this piece is that correlation versus causation. So just because two things are correlated, so they tend to move in certain ways, they can be positively correlated, so they move up and down in line with each other, or negatively correlated, so they move in opposite directions, or there could be no correlation at all. It doesn't mean that one causes the other. So when the FTSE goes down, it doesn't cause the pound to do the opposite, and equally the pound doesn't cause the FTSE 100 directly to do it. But there is a correlation, so it means that when they move, they tend to move similarly because of this correlation, or in opposite directions in the case of the FTSE and the pound. But causation is important because it doesn't mean one will make the other happen. And then as I go through the rest of the list, you'll start to notice the difference between that correlation and causation. So I'm talking about the FTSE 100. So what about the FTSE 250, the small caps? What is interesting when we come towards Brexit is anything you see that is related to UK GDP, so economic growth, will cause the FTSE 250 to move. So if I see the FTSE 250 move on a day, so the mid caps, so the smaller companies, those that are more exposed to the fortunes of the UK economy, then they will be impacted when you get a reading on the UK economy. So if the UK economic forecast dip, then you'll go and look, the FTSE 250 will tend to struggle on that day, and it may be that the FTSE 100 is actually up because it's something to do with the pound. So that is one to have a look at. I'm going to jump around a lot when I'm doing this piece, so I'm going to jump over to bonds versus equities generally. Now, the conventional wisdom is that bonds and equities tend to be good diversifiers. They tend to move in opposite directions. So when people are wanting to take risk and they buy equities, then bonds tend to fall. And equally in the other way, when everybody's spooked and they're panicked by what's going on in the stock market, they rush into bonds. Now that does generally tend to happen. But interestingly, that relationship is never constant. So it's not one like the FTSE 100 and the pound, which tend to stay in line with each other most of the time. The bond versus equity one tends to vary. So you'll get periods of time, like we've had recently, where they become positively correlated. So when bonds go up, equities are going up. It's not causation, it's correlation. They are both doing the same thing. But usually they will tend to move slightly in an opposite direction. But that is interesting because when you see the correlation change, which it does over time, and sometimes they're not really correlated at all, you've got to ask your questions why. Why is that happening? So when I look at bond markets, for example, on a given day, I might see that bond prices are falling. But I'll look at the stock market, and if that is also falling, then I'm going to wonder why. What's happened to cause everybody to just fear everything? What has happened to cause people not to want to buy bonds and equities? And that is where you start to learn different things that go on in the world. Particularly, in answer to that question, is often what central banks are doing. Now, I don't want to confuse things, but don't forget bond yields move in the opposite direction to prices of bonds. So when bond prices go up, their yields are falling. It's to do with the way they're priced. So that means that bond yields and equities tend to move in the same direction. So when people aren't wanting bonds, then the yields are increasing and they're normally going to end up buying equities. But you can see at some point, if bond yields become really, really attractive versus equities, which are more risky, people might start actually deciding I'm going to buy bonds now because the yields are pretty exciting. So that's why the correlation changes. But generally speaking, I look for the idea of what is the bond market doing, and for that I use the 10-year US Treasury yield as a proxy, which is TNX on your stock app if you want to look at it. I want to see what's going on there. That's the 10-year yield. So is the yield falling? If the yield's falling, that means people are buying bonds. So they're betting probably on economic growth falling, it could be, or central banks buying more bonds and treasuries. And what is the equity market doing at the same time? So it's that dynamic I want to look for. Moving on from that, if we focus more specifically on the S&P 500. Now, I like to look at America a lot. America matters. And in terms of their economy and their stock market, it's that thing, if they sneeze, the rest of the world catches a cold. So I'm interested in what's going on in the S&P 500 because it leads a lot of the other stock markets out there, because it influences a lot of other markets out there. Now, again, it's not correlation and causation. Again, it's this correlation versus causation aspect. But if you watch, if the stock market tumbles in America, it often bleeds over then into the next Asia session and then into the European session, because European markets close not long after American markets open. So if you get a late collapse in stock markets in America, have a look at what's going on in the Nikkei 225, so the Japanese stock market the next day, the Chinese stock market the next day when you wake up, I'm talking about, and then see what happens in the UK and the European markets when they open up the next morning. That's always interesting. Now, while we're talking about the S&P 500, people don't often realise that the German stock market and the S&P 500 have quite a high correlation. So they do tend to move almost in tandem and down in tandem. And recently that correlation has been broken. So European markets have tended to lag, particularly the German DAX. So I like to look at what's going on in the German DAX, because if we get a massive collapse, then you're looking over in the S&P 500 and thinking, why is that defying gravity? What's going on there? So there tends to be a correlation going on in those markets. And like I say, we've seen it break down. So I like to look at my stock app and see how those two comparing. Another one to look at is the BSE Sensex, it's called, and that is the Indian stock market versus the S&P 500. Now, it's not like a tight correlation, but there tends to be a slight heads up from the Indian stock market as to if things are going to be great or going to be terrible. Now, like I say, it's not, again, causation, but there seems to be a bit of a lead time where the Indian stock market, if it suddenly rallies, does really well, can be a positive sign that people like risk, and the S&P 500 often then tends to do quite well. And I think where it's most interesting, if you get a massive collapse in the Indian stock market, it can be a bit of a canary in the coal mine for the wider market and the S&P 500. So not something to obsess about, but it's definitely something to keep an eye on. Now, I've said I'm going to jump around, and I am. Currencies. Now, go back to currencies. Now, the yen and the Nikkei 225, so the Japanese stock market, there's a correlation there. So a bit like the FTSE and the pound, if the US dollar yen, so that strength, that pairing, if the yen strengthens against the US dollar, it tends to be bad for the Japanese stock market because it's very export focused. So that's another one. I always look at that exchange rate, which may seem an odd one, but that's why I look at it, because therefore, if the US dollar Japanese yen exchange rate, if the yen is strengthening, then it's bad news typically for the Japanese stock market. So that's one I will look at. But that then leads me nicely onto the dollar generally. We talked about the dollar versus the pound. We already covered that. But what about the dollar more widely? The dollar has a massive impact on investment markets. So I'm always intrigued to see what the dollar is doing, not necessarily against any other particular currency. I mentioned the yen and the pound, but you've got something called the dollar index, which is just the dollar value against a basket of currencies around the world. And it gives you just a broad indication of what the strength of the dollar is, or the weakness of the dollar. Now, the strength of the dollar will become a headwind for US equities in time if it kept strengthening. Now, on the dollar index, there's a number around about 98, which seems to be a key level. Above that, it could be a sign that the dollar's going to keep rallying, which would be bad for US stock markets. Below that, it's actually a possible sign that it could weaken. And we're in this scenario now where everybody's trying to guess where the dollar's going, and it's been jumping around but actually starting to weaken because of the interest rate cuts that everybody's expecting from the Fed later this month. But the dollar is important because the dollar not only impacts US equities, but it also impacts emerging markets. So emerging market stocks and bonds, they tend to do poorly when the dollar strengthens. And the reason for that is, if you think about emerging markets more widely, emerging market countries tend to have a lot of debt denominated in dollars. So they might borrow in dollars, but their assets are in their local currency. So if the dollar strengthens, then there's a mismatch between the income they're generating and the liabilities they have to pay out. But on top of that, when the dollar becomes strong, it becomes attractive. So think of it like a bank account. People are more likely to want to hold dollars because they can get a better return on it. So I'm thinking of like an interest on a bank account. It doesn't work like that, but just think of it because it helps you understand. So what will happen, people will sit there and think, if I go and buy the dollar, hold the dollar, I can make some good money. And dollar is often seen as a haven asset anyway. So they think, well, I don't need to go for these high yielding emerging market assets. I might as well take money back to the US and hold dollar denominated assets. And of course, what that means then is that people start selling down emerging market assets and they start buying things like the dollar or dollar denominated assets. And of course, that is an issue for anyone who's holding emerging markets. So that is one of the things. If you start to see emerging market indices tumbling, then you might think, why is that? What's happened? But keep an eye on the dollar. So these are, again, things that can help you understand and explain what's going on in the world. When you see the Fed is meant to be cutting interest rates, that means, lower interest rates. That means people don't necessarily want the dollar. The dollar will end up falling. That's got to be good for emerging markets. That could probably mean that emerging market equities and assets are going to rise in value. And then you look at your stock app the next day, and lo and behold, you might start to see there's been a little bit of a boost for some emerging market assets and indices, particularly maybe China. And of course, this is a longer term theme. It's not just day to day. It can be a general theme that goes over many months. Now, why I mentioned the dollar, it's interesting because the dollar is the currency that most commodities are denominated in. So when the dollar goes up in value, it tends to have a negative impact on a lot of commodities. It's because they become more expensive. So the cost of buying gold will be more expensive because you've got to convert into the right currency to purchase it. So therefore, gold and the dollar tend to be negatively correlated. So if the dollar rallies, then gold tends to fall. And the same can be said of other commodities such as oil. So you can see why, if you start to understand some of these relationships, which do break down, they don't hold all the time, but they start to help you join the dots of trying to understand a story that's going on in investment markets, which makes them fascinating. You read a story, and what happens, I always look at the story, whether it's whatever paper it's in, and think, what would be the impact based on some of the things I understand, the relationships that are meant to happen? What do I think could be the result of this story? And then see if it actually does occur. By doing that, you start to understand how these things behave, how markets behave, how they change, how they aren't always constant. And it then becomes a bit of a game and a bit of a puzzle. And that's how people become excited about investing, and how I did. I'm going to go through the others at a bit more of a quicker pace. Now, oil is an interesting one in itself. The price of oil influences the FTSE 100 actually, because there's a lot of oil stocks in the FTSE 100. So if the price of oil goes up, then those stocks go up. Energy stocks tend to do well as well. Oil tends to influence the price of copper. Oil and copper tend to be good bellwethers of the health of the global economy, which therefore has a huge impact on Chinese equity market. So if oil and copper tend to tumble, then people think because a lot of the demand comes from China, then it's a sign of Chinese economic growth falling, and then you start to see Chinese equities weaken more often than not. Then going full circle, copper tends to have a correlation with treasury yields as well. Because of that reason, if copper falls in value, then it means that the economic growth is probably going to be poor, so people might start to buy 10-year treasuries, and therefore the yield on them tends to fall. So basically treasury prices go up because people buy them, because bonds and treasuries tend to do well in poor economic conditions, and that's because interest rates shouldn't be increased, which means that their real return of the interest payments on them actually looks good or more attractive. So there's a correlation there. So like I say, this is all about correlation versus causation. There's lots of them that I've spoken about, which I hope you all grasp, but if you go back, listen to it, look at your stock app, try and see if you can spot some of these things happening. And what is interesting is when these correlations that often hold true start to break down, because they can be, to use the same phrase I used earlier, canaries in the coal mine, that something underlying is going wrong.
Okay, good stuff. We're doing a bit of a loan special. We're doing a couple of things on loans, but what have we got to start with?
Right, this is a quick piece on child benefit loans before we go on to the slightly longer piece on remortgaging versus taking out a loan. Now, child benefit loans, you heard of them?
I haven't, no.
I hadn't. This is something that's been going on for quite some time. 2017, this isn't anything new. It's just that I hadn't heard about them, as had most people not heard about them. But it suddenly came to the fore recently when one of the credit unions started talking about the demand for these particular type of loans.
Okay.
So what it is, credit unions, for anyone that doesn't know, they're basically institutions that are either not-for-profit or not trying to maximise profit. So they're self-funded through their members, which means they can end up giving lower rates on smaller loans, and they can give savings products too. So they end up being a good way for people to be able to take out financial products that aren't from institutions that aren't profiteering. So they really service a particular part of society, and they sometimes associated with employers or particular locations. Well, these credit unions have come up with a particular type of product to help people. Like I say, it's often small loan values where they can get a loan for £500, but they then have to pay, as part of an agreement, their child benefit payments into the credit union account, and some of that, a small part of that money being paid in, will repay that loan. So hence the child benefit loans. And this has been going on, like I say, since 2017. There's been 9,000 families that have been helped. £9 million has been lent this way. But it's a very interesting type of lending, because the idea is it's trying to stop people being called out by short-term payday lenders and having to use them. So it's a way of helping families on low incomes who are struggling to get a short-term loan that isn't paying extortionate interest rates. They're still high, but it's actually still capped. But it enables them to be able to repay it in an affordable way. So to give you an example, as I say, it's typically around about £500. You will agree to put your child benefit into the account with a credit union. Now, Manchester Credit Union have been doing it. They said there's a higher demand for doing this. then your child benefit will be paid into that account as agreed, and then you'll be charged an interest rate which works out to be the 42.6%, which is the maximum they can do, and in exchange you pay part of your child benefit to repay that loan. So an example is you might want to take a £500 loan for 50 weeks, which it will be repaid. You pay £12 a week from your child benefit to repay that loan. That equates to you having to pay £91.95 interest in total, or £1.84 a week in interest. But after that period, you have repaid that loan, and the rest of your child benefit would be accruing there. So some people have been saying that they love it because they just forget about their child benefit. It goes in there, repays the loan, building up a nice sum for them at the same time. So it's helping people to get a short-term loan that isn't being exploited, but also to save. Of course, there's been criticism from other areas saying, well, child benefit's meant to be spent on children, not as a sort of savings vehicle. But you've got to realise that people manage their finances in lots of different ways. So it's an interesting concept. I just want to throw it out there because it may help some people. There may be people you know who may benefit from it. If you want to find a credit union, then you can. If you go to findyourcreditunion.co.uk, there's a website and a search function that will help you find credit unions.
Okay, so moving on to the last loan piece, remortgaging versus loan. So specifically, we're looking at whether it's better to remortgage or take out a personal loan.
Yeah, so we've done a piece on the website which goes into full detail on this. So if you want to find it, you can go and find the full article on moneytothemasses.com. And we looked at the idea of remortgaging versus taking out a loan, particularly if you wanted to do some sort of home improvement project. And it's something that's particularly relevant to me because it's something that I'm doing. So I'm going to rattle through the pros and cons of remortgaging versus the pros and cons of taking out a loan. So first of all, the pros for taking out a remortgage. So you're going to go and get a new mortgage to replace your existing mortgage, and you're going to try and borrow a bit more money to be able to do the improvements or whatever it is you're trying to do, repay debt or whatever.
And does it work as you're doing the whole lot when you do it, or are you taking out like an extra little thing that bolts onto the side?
Well, let's talk about doing the whole lot, because I'll come on to that, because this is why I think it's relevant, because I want to talk about my own experience in a minute. So let's say if you're going to do the whole remortgage, then what happens is you're going to end up having to repay the loan over a longer period of time, but it brings down the monthly cost. Because if you think you want to borrow a little bit more money and you're going to remortgage your existing mortgage, which ultimately, therefore, that mortgage is repaid, you get a slightly bigger mortgage, then that is going to be spread over a lot longer, 25 years, say, and you're going to get a better rate. It's going to be lower. The loan is secured against your property, though, so that is why you're able to get that longer loan. But then obviously, if you don't keep up repayments, then you will have your house repossessed. I feel like one of those adverts you hear on telly. But it also means you can consolidate some of your debts. Now, I will say that if you do go to remortgage, they will ask you if that's what you're trying to do, because from a lender's point of view, they want to know if you've got lots of debt and you're trying to bundle it into one consolidation, because it's all about debt management. And for them, that is still a risk about the amount of debt and credit that you have available. The cons of doing this, obviously, apart from you could have your house repossessed, but if you've got a mortgage already, that is a given. You already know that. You need to have sufficient equity in your property, obviously, to do it. And it's not ideal if you're planning to move, as not all mortgages are portable. Now, portability is where you can take a mortgage and move it onto a new property if you decide to move. Now, if you go back a couple of episodes, I can't remember which episode on the podcast we talked about it, but there was somebody who decided they were going to move. They got a long-term fix mortgage that was portable. They decided they were going to move, didn't realise that the portability, some of the T's and C's on that particular contract meant that they had to, when they moved, they could port it, so they didn't have to pay the early redemption charges, but they also had to take out the additional borrowing from the same lender. So it limited their choices and ultimately meant they had to pay a little bit over the odds. So bear that in mind. Of course, when you're remortgaging, the other thing you've got to think about is, are you going to get a tracker or fixed term mortgage, because there are going to be early repayment charges on a fixed term product. If you are repaying over a longer period of time, then it's going to increase the overall payments that you're going to make, obviously, because you're going to be paying them for a lot longer. And the other thing to bear in mind, that a remortgaging, you're going to have to pay possibly arrangement fees and or solicitors fees. So there's the pros and cons of remortgaging. Now, if you want to go and take a personal loan, now the one positive of a personal loan is it's quick and it's not income based. So you could go out there and get a loan. You're not going to necessarily have to prove with affordability, which you're going to have to do with a full remortgage. They're going to scrutinise your finances on a remortgage, which could be bad news for a lot of people because their affordability may have changed since they took the original loan out.
So they'll just kind of look at your credit report, and if you're clean as a whistle, it's likely you'll get accepted almost immediately.
If you're on a loan, you're talking about.
On a loan.
Yeah, so on a loan, it's going to be based down to your credit report, which would influence what interest rate you're going to get on that loan as well. So it's going to be a lot simpler, it's going to be a lot quicker, and there's going to be no solicitors or arrangement fees involved. On a positive, the debt will be repaid quicker. Now, it depends who you are, and that might be a negative because the loans are a shorter term by typically they're only going to be up to about 7 years versus something that's much longer term on a remortgage. So it means you're going to have to repay the debt, which means you're going to be cleared of the debt, but it will probably mean you're going to have to pay back a bigger chunk every month on that debt. The other positive, obviously, is that your property is not at risk. Now, as I say, the cons, you're going to pay higher monthly payments due to the shorter term, and there's a restriction on the loan amount. So if you're wanting to borrow more than, say, 30 grand, you're probably not going to get it on a short-term loan. And of course, like anything, if you miss payments, it's going to impact your credit score. Now, you can see from those pros and cons, it's probably quite clear for most people which is going to be better for them. It's going to be about monthly costs versus speed of acquisition. It's going to be taking into account their credit report and also the amount of equity they've got in their property and also their future plans. Now, the reason I said this is relevant, I want to throw something into the mix for my own personal life. Now, I'm doing a similar thing where I'm thinking about maybe moving in the future. I'm thinking of I want to do some home improvements. I know that I don't want to be just stuck with my existing lender because there are obviously better deals around. I've been in my property a long time, so I had some equity in my property. Now, there is a slight alternative somewhere in the middle of those two, if it were. It's not a remortgage, obviously it's not a short-term loan, but you could go to your existing lender and ask them to give you another mortgage for the additional borrowing that you want. Because the reason this is occasionally a good idea is because if your deal that you're currently on is so good that you don't want to lose it, because if you could remortgage the whole existing loan and the additional borrowing and you might be on a lower rate, but the T's and C's, in my case, are so good on the original deal that you're sitting there thinking, if I ditch this, then I'm not going to be able to get it back or anything as good as this. And also I want the flexibility because I don't want to tie myself in on a fixed term deal or anything like that. You're happy where you are, but you just want to borrow some additional money. It is possible to go to your existing lender who will look at the loan to value that you've got so you can still get really favourable rates. And they might even be some of the best rates in the market depending on which lender it is. You can therefore get a second bit of borrowing, say for example we said here 20, 30 grand, that is a separate product that's bolted on alongside your existing lending. It doesn't impact that. And you can get the money over the same term as your existing mortgage, but it means you aren't going to be under quite the same depth or level of scrutiny of your finances than if you're doing a full remortgage. Now, you're going to still go down the affordability route. You can't afford that because you are borrowing some more money from your existing lender. They're going to look at your existing debts. They're going to look at your credit score, all that kind of thing. And they're going to ask about your monthly spending. But there's a good chance that what they won't do is go through and ask for individual statements of every month. And they sit there and go, what's this on there? What's this spending? What's that? They might take your word for a lot more of what you say your spending is. And that's going to be partly down to the fact that you've already afforded the mortgage you've got already. You're asking to basically, if it's repayment, to borrow back some of the money you've already repaid. So from their point of view, your risk is much lower. So it can be almost a third way. You're not remortgaging. You're borrowing more, a new mortgage from your existing lender, which can still give you all that flexibility that you wanted had you not even taken out a new loan. So I'm going to throw that out there because there will be a lot of people who don't realise that is an option. So I hope you found that useful. But as I say, you can find out more information on the website.
Good stuff. Well, that is it for this week. We have got to wrap it up because Damien's off to watch his daughter win a few races. Although it's not the winning that matters, it's the taking part, obviously.
It's not the winning that matters, it's how many people you beat.
Yeah. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com or Twitter is at moneytothemasses with a number 2. Get over to Instagram. Do please subscribe to our YouTube channel. We're getting lots and lots of people subscribed. We really thank you for that. It's growing massively and there's going to be more and more videos coming out soon. And I'll put the links to that article about the remortgaging versus loans on the website. Damien, we're done.
So yes, we are done. So see you on Facebook on Monday between 12 and 2. And apart from that, see you next week. week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.